Good afternoon, everyone. My name is Evan Bradley. I'm the Chief Financial Officer for Campbell Property Management and one of the 5 owners of the company. I'm also a licensed CAM, and I work very closely with some of our largest clients on the major issues facing their associations. For those of you not as familiar with Campbell, we've been in business since 1953 and managed over 400 HOA and condominium association clients from Dade to St. Lucie counties here in South Florida. Our guest speaker today is Nicole Johnson. She is a CPA and a partner in the firm Hafer LLC, which is an HOA and condo auditing firm here in South Florida. We've had the privilege of working with Nicole for several years, and she has a great reputation for her audits. So, Nicole, would you like to introduce your firm and take us through your presentation today?
Great. Thanks so much, Evan. I appreciate it. Good to see everybody Zoom-wise, and I get to see all your great faces. So hopefully in the near future, we'll all be back in person. So this is an exciting class. Well, for me it is. For all of you, it probably won't be, but I try to make it as fun as possible. What is an audit? So many of you are going through the process, or you've been through the process, because we're almost up to April 30th, which it is due by statutory requirements to all of the unit owners. I'm really going to walk you through what an audit is, what is expected on the auditor's part, what is expected on the board of directors, and kind of give you an overview in an hour, which I will definitely finish in an hour, but I know that auditing is definitely much longer than an hour. So I'm going to give you an overview. I will make the presentation available to anyone that wants a copy of it. They can send me an email and I can send you the PowerPoint presentation. And then you can go back and reference it, because some of the slides I'll go a little bit quicker, because it's just kind of giving you an overview of what the auditors do and what you should expect from them. So as you're all aware of, that statutes does require that any income over $500,000 does require an audited financial statement, unless your documents state differently. I have some associations I do that their documents actually require an audit and their income is under the 500,000. So you really have to check into your documents. But people will always say to me, well, even if the statute says over 500, why should I have an audit? What if I'm under 500,000? What is the purpose of an audit? I'm hoping today you'll see the purpose of why an audit is great to have as a board member. A lot of you board members are volunteers. You don't maybe have the experience of financials, understanding it. If you're in a self-managed property and you're relying on, one reference of a property manager to give you all that information, sometimes it can be overwhelming. So having a third party or having an auditor come in and give you that understanding of that financial is very important. Also, in the last year and a half, through the pandemic, through what happened in the tragic Surfside event, many people are saying, we really need to know what's going on in our financial statements. So I'm hoping today through this audit process, you'll understand that. We'll do some jokes. Accountants are just so funny. So I'll try to make it a little bit funny for you. How did the auditor propose to his girlfriend? With an engagement letter. So an engagement letter is really the start of an audit. You need to make sure that you have an engagement letter signed. Always make sure that engagement letter is signed ahead of time. Please don't wait until January, February, March to be reaching out to your auditors to have a signed letter, because they're really busy at that time of year. They like to know ahead of time to get ready, because preparing for an audit, there's a lot of work involved in regards to processes, internal controls, things that we have to do, and we have to be prepared for that. Why are accountants so calm, composed, and methodical? They have strong internal controls. So we're going to talk a little bit about the internal controls of the audit process and what you should be expecting. I'm going to kind of quickly go through that because that's a small portion of the audit, but I want to make sure that I do highlight some of those areas. Accountant joke. What do you call a trial of balance that doesn't balance? A late night. So we have a lot of those late nights. Sometimes, sometimes in the self-managed properties or in some of the other ones, we have issues that the balance sheet doesn't balance. And the purpose of a balance sheet, it must balance. Assets must equal liabilities and equity. We will talk about that. This is a good one. I like this for HOAs and condos. Insomnia, anxiety, irritability, definitions of clinical depression. You wouldn't happen to be the president of an HOA. I thought that was kind of funny because a lot of board members, especially when we go through the audit process, get a little bit stressed if they have no background in any type of financial. So they always say what needs to happen. So just a little bit of some internal control mistakes. Some of the things I just want to highlight quickly. I'm not going to go through every slide detail by detail. I will allow you to have a copy of that presentation. So internal controls start with a strong set of policies and procedures. It actually starts with a strong control environment, making sure the board of directors and management is really making sure that things are being done properly. Management is the owner of the internal control. So the board of directors is owners of that. They need to make sure that they're making sure those internal controls are being done. Internal control is an integral part of every association. It's the foundation of the financial statements, to making sure those controls are placed and that financial statements are reported accurately, timely, and free of material misstatement, which we will talk about. And remember that financial statements are not absolute assurance. What I mean by that is you want to make sure your financial statements are presented free of material misstatements. What I mean by that from an audit perspective, that, for example, accounts payable, that all of your material accounts payable are booked for. So let's say you're an association of $1 million. Anything over $5,000, you want to make sure is booked. Things that are $100 or $200, a lot of times the auditors aren't going to book those entries. They're going to say they're not material and they're going to book anything over that. They're not actually doing the bookkeeping. They're auditing the books, which we're going to talk about further in the presentation. What is internal control? Making sure that information is reliable, accurate, and timely, that what you're presenting to the association and to the owners is accurate. Internal controls helps that. Making sure you're abiding by all policies, procedures, and especially laws and regulations. As you're all aware of, you fall under either 718, condominium law, 719, cooperative law, or 720, HOA law. And you need to make sure that you're in compliance with that. A lot of the audit perspective is making sure that you are in compliance. A lot of these audits that are performed, they're called compliance audits, to make sure that everything you're doing is in compliance with statutes, that you don't have anything you're in violation of. Very important to make sure, and make sure that we're preventing errors or irregularities, or if there is potential fraud, that is being uncovered. To ensure success, make sure that there's not bad decisions. So a lot of people like to call fraud. They say, oh, I get phone calls all the time. There's fraud in our association. Well, it's usually not. It's usually just either mismanagement or they didn't like the decisions of the prior board. And that's not fraud. So you want to make sure you're not using that word. And just because a board, when we're doing an audit, a board chooses, they get 3 contracts and they choose the highest vendor. That doesn't mean that there's fraud. That means maybe that vendor they chose does better service or is it better for their position. So don't always use that word. I always tell all of my associations, the 750 that I do, you want to make sure you don't use that word, because until that's proven in a court of law that somebody's done that, you don't use that word. Poor managers, unethical behavior in internal controls, collusion, kickbacks, and overrides of internal controls are things that we're looking at from an audit perspective. Could this be going on? Who's responsible for your financial statements and your audit? The first people in line that are responsible are the board of directors. A lot of times I'll do an association's audit and they'll say, well, the management company made that decision. No, the management company cannot make the decision, the final decision on the behalf of the association. The ultimate decision makers are the board of directors. Your management guides you in the right way to make sure that you're in compliance, but everything falls on the board of directors. Management guides, and then personnel takes guidance from management, which is also directed by the board of directors. Responsible of internal controls, as I said, the board of directors, management, and then the independent auditors gain assurance and understanding of the internal controls. We are not the ones that implement that. At the end of the audit, you will get a letter called an AU265 that will give you internal control recommendations. It doesn't mean that you have to do them. They are just recommendations, which we'll talk about. Control activities, do's and don'ts. Who's approving it? Who's authorizing it? Verifications, reconciliations. Are there segregation of duties in the community? Security of assets. Who's protecting those assets? Are the board of directors overseeing all of this? And information system controls. This is all a part of the audit process, is looking through all that and verifying that this is being done and reporting to you if it's not. We're going to go to the next one. Some specific internal controls I just want to highlight. 2 signatures on all checks. If it's electronic, that's fine, because most associations are electronic now. But are there 2 approvals, 2 signatures? No rubber stamps. I haven't seen them in many years, but you would be very surprised. Many audits I've done in the past, I've been in this industry now for 18 years. I went to a property to do an audit and they said, we do not use rubber stamps and we do not leave unsigned checks anywhere. And I came into the office and they had 2 rubber stamps sitting on the desk. So I know that's very old school and most of us are on the electronic way, especially since the pandemic. No blank checks to sign, limited authority, supporting documentation. And these are the kind of things that make your audit much smoother when you're doing the good internal controls. Understanding the financial statements, the audit process. Very important if you're going through it right now or you've been through it, that you understand what the auditor is doing. I am going to walk you through the entire financial statement and what we do as auditors. I'm going to go through the balance sheet, the income statement, the footnotes, and walk you through what auditors do and what they expect from management, from the board of directors through the audit process. The objective of financial statements. What is the purpose of having an audit done and the financial statement? Making sure that your end user, and what I mean by that, an end user, a potential new buyer, a board of director, a unit owner, that the end user understands the transparency and the financial position of the association. Are we financially solvent? Are we funding our reserves? Do we have issues with compliance? Do we have issues with internal controls? These are the things the auditors are reporting to the board of directors. And once the audit is finished, this gets reported to the unit owners. It's very important, especially in this market right now in Florida. Many associations are asking for audits because the end user, which is a new unit owner coming in, wants to see the liquidity or the financial stability of that association. Do you have debt on the books? This audit gives that, and it's a third party, an independent auditor, which your auditor must be independent. The person that's doing the bookkeeping cannot also be doing the audit because they're not independent, to make sure they're giving an independent opinion. Remember also one very important thing in an audit process. The only thing that the auditor owns is the opinion. Everything in that financial statement is owned by the board of directors in the association. Your footnotes, your financials, your adjusting entries, they are all owned by the board of directors in the association. So when you accept that audit, you're agreeing with what the auditor put together, and then you're also signing off on that. What is the need for a financial statement? So Florida statutes 718, 719, and 720 require that if your income is over $500,000, that you must have an audited financial statement. If your income is $300,000 to $500,000 is a review, and $150,000 to $300,000 is a compiled financial statement. Remember that in the statutes for the compilation report, $150,000 to $300,000, you are not required to have it done by an independent CPA firm. The only independent CPA firm in the statutes that's required is a review and an audit, because an audited report and a review can only be done by a CPA firm. So the compilation does not require that. And I get questions all the time, what is the difference between the 3 reports? Because we might be required to do an audit, but we had a membership vote and we decided to waive the audit to do a review. So an audit is the highest level of assurance on your financial statements. What I mean by that, what is assurance? We are actually going in and we are testing. We are going through your invoices. We are going through your contracts. We're reading your minutes. We are attesting to everything that you have put together and putting a financial statement together based on that. A reviewed financial statement is analytical procedures. You're not going in and testing the invoices, the contracts. You're not verifying any of that. You're doing analytical. So you're looking at last year. You're looking at this year. You're looking at budget versus actual. What is the comparison? Why is this number higher than last year? But you're not going in the detail. The detail is really in the audited financial statement. A compiled financial statement, there is no attest work. There is no assurance. We're basically taking your financial statements, putting them on our letterhead, doing some work on them, making sure that the financial statements are presented, but we're not doing any attest work. So it's a very low level reporting, and there is no opinion on the compilation or review. The audit, there is opinion, and there's many different versions of opinions, which we're going to talk about. The benefits of an audit is assurance. As a board member, if I was a volunteer board, and I was making sure that I was safeguarding all these assets on my balance sheet, making sure that I was in compliance with statutes, I would want that level of security, knowing an independent firm came in and audited that when they're reporting it to the unit owners. So it's very important, I feel, as a board member, fiduciary responsibility to report this to the owners to make sure that they're accurate. We just went over the buzz question, so we all aware of what's required. What is GAAP? Generally accepted accounting principles. So there are specifics on what you are required to do on an audited financial statement, audit review, or a compilation, that they are in compliance with GAAP. There are many guidelines to that. The number one guideline that you should be abiding by is, are you on an accrual-based accounting? I have many associations that'll call me and say, well, we want to be on a cash basis. So let me explain a little bit about that. The state requires that you're on accrual. Cash basis, you have a financial statement. It's cash in, cash out. If you have a loan on the books, that will never reflect. If you have a special assessment that you pass, that will not reflect. If you have accounts receivable that people owe you money, that will never reflect on a cash basis. That's the importance of accrual-based financials, is that you are reporting to the end user, your unit owners, potential buyers, of the true financial stability of that community. If you had $1 million debt on the books and you weren't reporting that to them, and they say, oh, wow, they had a surplus last year and they have $200,000 in cash and they have reserves, they're doing good, not realizing that there's an outstanding liability out there of $1 million debt. Review of audit process. So we must get an understanding of the internal controls. It's required. As an auditor, you must get an understanding. So a part of the audit process, and all of you that have gone through it, is interviewing the board. So it's interesting, we'll put out a list of questions to our communities and say, this is what we need for the audit, we must interview the board. And I'll get questions back. Well, the board doesn't know if they can answer the question, they're nervous, they don't want to do the phone call. And I say, it's fine, there's nothing to be nervous about. We're asking you questions about what's going on in the association. What happened last year? They're going to ask questions about signatures. What happened through the year? Did you pass special assessments? Are you fully funding reserves? Because the purpose of the auditor is to get an understanding of what happened through the year. And what they do is they listen to those answers, and then they go back to the minutes, they go back to the financial statements, and they verify this is what's going on. If you as a board member are telling me you passed a special assessment, and I go back to the financial statements and there's no special assessment booked, I have a concern. These financial statements are not accurate. Determine the plan level of control risk. So audits now have really changed in the last couple of years in regard to risk assessment. They really geared audits to risk assessment, risk controls. So instead of sitting down and saying, okay, we're going to put a number together, this is materiality, and anything over $10,000 you're going to look at. The problem with auditing in that process is somebody that's doing something or an error or a problem is going to know, I'm not going to write a check to myself for $10,000. They're going to be smart about it, or there's going to be an error on things under that. So what they did was, you have to sit down and you have to assess all the risk areas. So one of the things that all of you that have gone through the audit process already this year, I'm sure you've gotten a letter. It's called the AUC 260. And when it first came out, I think everybody got a little bit concerned. We altered our letter to be a little bit more understanding to the end user. But what it states is, to the board members, prior to the audit starting, is a pre-audit letter. And what they're stating to the board is, these are the areas that are high risk. These are the areas that we as auditors have concerns with. Not saying anything's going on, but we're letting you know ahead of time the areas of risk. And that's good, because as board members, you're being informed now the areas prior to the audit that the auditor has concerns with. So some of the areas might be credit cards, reimbursements, things that are cash. Do you accept cash? They're looking in those areas. And every association is different. Nothing is the same, because every control is different. Are you with a management company? Do you have levels of segregation of duty? These are the things that are cause less risk versus high risk audits. The higher risk audits, there's going to be additional testing. So the next area is our testing. I know someone had asked a question, some of the questions about Where do you get that sampling from? How do you know what to test? So as auditors, a lot of auditing is your gut feeling. When you get a general ledger and you start going through that general ledger and you start seeing transactions, okay, do they have credit cards? Well, let me go to the credit card statements and look at them. Let me see what they're spending. Do they have cash advances on the credit cards? That's a problem. Why would an association need that? What's the balance on that credit card limit? If it's high, your association's a $10 million association, you might have a higher limit. But if you're an association with $600,000 in revenue, why do you need a $100,000 American Express limit? These are the things the auditors are looking at. And then when they look at that and evaluate the risk areas, that's how the testing comes about. They start looking in those areas. Do we look at every FP&L bill? No, we look at that and say, okay, are they consistent? In January, it's a little lower. In the summer, those FP&Ls go up. We look at comparables to the prior year. Is it consistent? Maybe we don't need to look at those invoices. Credit cards, why is it higher in the summer versus in the winter? Looking at those statements, looking at those backup. We do a lot of testing to complete the audit. Accounts payable is another area of testing. We want to make sure that every bill, well, most of the bill materiality is recorded in the proper period. So if you're with a great management company, like I know we do a lot with Campbell, and they have minimal adjusting entries. So what that means is they're booking everything in the proper period. So they are waiting till their financial statements are complete. And we appreciate that because you shouldn't be sending me an audit to be done January 3rd. There's no way possible that everything has been booked. So usually the audit process can't start till the end of January. That means the management company did a good job of making sure things are booked. Of course, things come in February, and that's how we look at that and say, does it need to be booked in the proper period? That's making sure your financial statements are correct. And then we form an opinion. So what that means is there's many different versions of opinions. There's the unmodified opinion. That's a clean opinion. Highest level of assurance on an audit. You want an unmodified opinion. A modified opinion means there's a departure. There's not a material departure, but a departure from GAAP. So it might be that you guys don't capitalize anything. Association, you might say, we're going to expense everything. Well, that's a departure from GAAP. And if it's not material to your financial statements, then it would be just a modified opinion. I have many associations that choose to do that because they want to expense everything. Then we have something called a disclaimer. That means that we are not able to get enough information to be able to even give an opinion. And that's a problem. Associations that maybe don't want to sign the management rep letter. Maybe they don't want to sign some of the forms that need to be signed. They can't find bank statements. That's a problem. So the auditors aren't going to put an opinion on that because they're going to say, we don't have enough evidence to give an opinion. And then there's an adverse opinion. An adverse opinion I have never issued in our firm ever, and we hope we never have to. Most likely we would disengage. That means it's a material problem to the financial statements, and the financial statements are basically wrong. So that's a problem. I don't think I've ever seen one in this industry. Disclaimers I have seen where associations aren't able to find records and be able to do that. So this gives you, what I've done in my presentation is given you detail by detail of every opinion. So if you get a copy of this, you're able to refer back and understand the different type of opinions, which really help you get an understanding of what is your opinion. It's good to go through this and say, let's go back to my audit and see what opinion I got. I always recommend also is that you have a closing meeting or even ask questions to the auditor at the end. If you don't have any questions, that's fine. But even, make sure you're meeting the auditor, either through the beginning process, that the interview, you've been interviewed, or you've had a closing meeting, or you've touched base with the auditor. So you get an understanding of what they're doing. So these are the different type of opinions. We'll be able to look through that and see there's the adverse and the disclaimer. They're the two opinions you really do not want. As a board member, I'd have a concern if I was getting an adverse, a very material departure from GAAP, or a disclaimer of opinion, especially the lack of records, because that means that you're not abiding by statutes either. You're required to keep all of your records, and you're required to keep them for your association, regardless if you're self-managed or you switch management companies. The onus is on the board of directors to keep those records. It's interesting. I had an association a few weeks ago. They were self-managed, and then they went to a management company, and then they decided to go to another management company, and they said, we can't find our records. It's not our fault. Well, the situation is the board of directors is responsible for those records. You're responsible to make sure that you have them all. If you transition over, to make sure that you do get them and you have them on site. The audit report. So the audit report has changed in the last couple of years, and especially this year. So if you have a new audit report this year and you compare it to last year, it's very different. There are many added disclosures to the audit report, but I'm going to highlight you through just kind of understanding how to read that audit report. So in the first paragraph, we basically tell you that we have audited your financial statements. We have audited the cash flows, the fund balance, the statement of revenues and expenses, the balance sheet, and it is our responsibility to express an opinion. We must express an opinion. Even if we don't issue one and we issue a disclaimer, we are responsible to give you some type of opinion. Then we tell you that we've conducted our audits with accordance with generally accepted accounting principles, also generally accepted auditing standards, that we have abided by all that, that we have included examining on a test basis, make sure that evidence supports what our opinion is. We don't give you all of our work papers, but we are stating this in our opinion that this now ties to what we've done in our evidence, that our work papers can back this up on our opinion. Then the most important is that third paragraph. In our opinion, such financial statements are presented fairly in all material respects, the financial position of the association. That's your opinion. You want to make sure that it is fairly presented. The disclaimer would have something saying that we weren't able to, and it gives you a reason why. So if you have a disclaimer, it will tell you the reason why they were not issued. We couldn't get evidence of something. We weren't able to get a legal opinion, something of that nature. And then it goes through and it gives you the supplemental information. So the supplemental information is required under 718 condominium statutory reserves. That is the reserve schedule. If that is omitted, which it's not allowed under 718, that's a problem. It would affect our opinion. If you're 720 in your non-statutory reserves, not statutory, which the developer established them or the unit owners voted for them, and that is omitted, in this paragraph, it will say that management omitted the supplemental schedule. That doesn't affect our opinion because by Florida statutes, if you're not statutory reserves under 720, it's not required. We always recommend that you get a reserve schedule done and have it as a part of your budget in the audit process, but it's not required under 720 for that if you're non-statutory. And we also put in that opinion that we do not express an opinion on the supplemental information. So the reason why is I've had a lot of questions this year regarding the supplemental schedule. And they say, why do you put in there that it's unaudited, that you don't issue an opinion? The reason is I'm not an engineer. That report at the end of the audit, which is also in your budget, which is required under 718, is to be done by either an engineer, a reserve company, or because it's not required by statutes, the board of directors can put that schedule together, which I don't recommend unless you are an engineer, because you're putting together estimated replacement costs. You're putting together estimated lives on that value of that reserve item. And that gets disclosed in the audit. Well, we as auditors, we don't know what the cost of that roof is, and we don't even know if that's accurate. Even if you had an engineering report, you're relying on that professional. We are not in that profession. So it's a lot of people have those questions because they say, well, you're auditing our financial statements. Why is that not a part of it? And that is the main reason, is we do not give an opinion on things that we are not concentrating on. Auditors concentrate on the financial statements of the association. And then we make sure at the end, we disclose about future major repairs and replacements and make sure that is disclosed, because that is, it's not a required part of the financial statements, but it is for compliance issues. So for 718, 719, and 720, it is required to be disclosed in the audited report. What is a balance sheet? Balance sheet is the most important part of your financial statements. I do so many closing meetings and the associations will say, well, our income statement, I want to know if we have a surplus. That's the most important to me. It's really not. And you really, yes, definitely want to know if you have a surplus and how you did last year, but your balance sheet is a statement of your financial position. It's really the meat of the entire audit is your assets, your liabilities, and your owner's equity, which is really your fund balance, is how do you sit financially? This, assets equals liabilities plus your shareholders' equity, which is fund balance. It's very important. You want to make sure you understand the balance sheet out of everything, of where it comes from, what is going on in the audit process. Current assets. So that's anything that's a lifespan of 1 year or less. So most associations really only have current assets. So current assets are your cash position. What is your cash position in that association? Standard in the industry for CIRA. CIRA is CIRA, Common Interest Realty Associations in the state of Florida. Standard in this industry is 2 to 3 months worth of operating cash if you are funding reserves. And I want to make that clear, because if you have 2 to 3 months worth of operating cash, but you waive the reserves every year, that's not very financially stable, because you have nothing to back up anything that happens in those capital assets, which we will talk about. But your current assets, your cash, do we have that? Do we have that 2 to 3 months? Do we have CDs? Are we protecting our money, the $250,000 or more, by FDIC, sweep accounts, CEDARS programs? And you can talk to your management companies like Campbell about that. They have many vehicles that will protect you over that FDIC. Part of the audit process is looking at that, making sure that you are protected. And if you're not, there's a disclosure in the footnotes regarding that. The FDIC has a separate footnote explaining if you're over, the FDIC. And if you are, it will be fully disclosed in the audit report, and making sure that it is disclosed. Accounts receivable. Part of the audit process is to make sure that those receivables are accurate. So a part of the audit process is looking at subsequent. We look at January, February, March of the next year. If you had a receivable that was outstanding at 12/31, but we see that it was paid in the following year, there's not a concern of bad debt, because we know it's been paid. If it's still outstanding in the next year, questions to the board of directors is, do you believe this will be collected? Do you believe this is bad debt? A lot of board of directors will ask us, what do you think the bad debt should be? The auditor can't tell you that. The auditor has to audit that number. So when you do your budget and you're doing your financials and you put in an allowance for bad debt, the auditor comes in at the end and audits that number and says, is it realistic? Do we believe this is a good number? Are you understating or overstating your receivables? So our job is to audit that. Same thing with the cash position. Cash is king. We need to make sure part of our audit process is we get 12 months of bank statements, and we're going through that cash statement. We're going through those reconciliations. Are there outstanding checks? Are there outstanding deposits? Things like that, and looking at that and auditing those numbers. Liabilities. So a very important part of your balance sheet. And that's why when we talk about a cash position, it's not a good position you want to be reporting on, because you'll miss out on all those liabilities. So a part of the audit process is going down the balance sheet and looking at those liabilities. So the first start is the accounts payable. We look at everything that is booked as of 12/31. And then we look at a check register January, February, March, depending on when the audit is due. If you tell us March 15th, we usually have the audit done by February 20th. So we're looking at check registers January and February. And we're looking at that check register and saying, are those invoices that are associated with the prior year booked as an accounts payable? And if they're not, we're making an adjusting entry to make sure that it is booked. And then we give those adjusting entries to your management, and they book those so the financial statements are correctly stated. Prepaid assessments. It's another area that we're looking at, is in the cash position, what revenues that were collected are really for the next year. A lot of times you bill in December for the following year and you collect some of those. Well, they're not really revenue. That's revenue for next year. So we look at those prepaid assessments and say, Are those prepaid assessments supposed to be a liability or are they revenue? We're evaluating that. Your notes payable. Do you have a loan on the books? We're getting a statement from the bank and making sure that that loan that you're showing as a balance at 12/31 is correct. Is the interest booked correct? Is the principal booked correct? You'd be very surprised. That's one of our area of a lot of adjusting entries, because a lot of associations do not like to see on their budget versus actual a variance. So when you're making a payment for the loan, only the interest is an expense. Only the interest goes on your income statement. The principal goes to reduce the note. And a lot of times boards will tell the management, please just leave it all on the income statement so our budget versus actual is correct. And nobody thinks that we're really under because the principal's going to the balance sheet. Well, that's a major adjusting entry at the end of the year, because that note payable won't be correct if you don't adjust it accordingly. One of the other things I want to make sure that I bring up before we leave the balance sheet area too is on the cash position. This is a lot of questions we get asked why we do it this way. So we must verify cash at year end. And a lot of times in the past, they used to send out confirmations to the banks. And what happened was they would send a letter, and we would get back the balances, and they were never right because a teller did them. They did it at the date they received the letter. So one of the areas that was very high risk was CDs. And CDs do not issue statements. We're all aware of this. They do not send statements year end. We must know that exists. And a lot of times board of directors will send us the 1099 and they say, we know it exists. A 1099 does not prove it exists at year end. It proves you received interest through the year on the CD, but it does not mean as an auditor for us that it exists. So what we usually ask our board of directors for is, if a bank can give you a printout at year end of what exists in that CD, something on the bank's letterhead saying that exists, even an email saying that it exists at year end. A 1099 is not sufficient. Equity, very bottom part of your balance sheet, very important part of your balance sheet. Do you have 2 to 3 months in that equity? Do you have positive equity? You cannot run your association into a negative. If you do have a negative fund balance, it is a comment in the footnotes. That means your association is not financially stable, that you're running your association into a negative. How that fund balance is determined, for anybody that doesn't understand where equity comes from, on your income statement, every year you have a surplus or deficit. That surplus or deficit rolls into your fund balance. So if you have a positive fund balance on your balance sheet and your income statement, that means you've had more surpluses than deficits. If you're in the negative, that means that you've had more losses, and it's something you need to look at. You need to, as a board, say, are we assessing enough to our unit owners to cover our expenses? It's a problem. The only one-off on that, and I want to make sure I'm clear on this because I've had it happen a few times this year. Some associations are in really large deficits. I did one a few weeks ago when they were about in a $3 million deficit. The board at the end, we did our closing meeting, said, the unit owners they're going to go crazy. We're in a $3 million operating deficit. Well, the reason was they took a loan out. And there's nothing wrong with that. They took a loan out to pay for the capital expenses. The issue is loan money is not income. So on your income statement, all those expenses are recorded, but there's no revenue to offset that. So what you need to do is you need to speak to the auditor and say, let's put a disclosure in there saying, this was the reason for this deficit is that we took a loan out and we're either going to special assess down the road to pay the loan back, or we're going to pay it through the budget. You need something to pay that loan back. And as that loan is paid back or you special assess, that revenue will get recognized and that deficit will go away. So it's very important to understand that, because if you don't disclose this or talk to the auditor about this, you could put out a final audit report and then an end user, like a new buyer or a real estate agent, reads that and says, wow, this association is running into a deficit. We don't want to buy there, when they don't understand that you've really taken on a loan and you're paying that back over time. So the balance sheet, your assets, cash and cash equivalents, very, very important. Make sure you're 2 to 3 months. that you're financially secure. Accounts receivable. Are you looking at that as a board member? The auditors are looking at a year end. Are they good numbers? Are you turning it over to the attorney timely if somebody is delinquent? Allowance for bad debt. Are you looking at that? Are you including that in your budget? If you're not, why? If you have a lot of delinquencies, if you're not putting an allowance for bad debt, that's a problem. As auditors, we're going to question that and say, why aren't you putting that in? Because you're not receiving all that revenue. So if you're not including an allowance for bad debt, you're going to be short at year end. What's the reasoning for that? We look at prepaid expenses, especially associated with your insurance policy. When you put a down payment down, that's not initially an expense. It gets amortized over the contract of that insurance policy. So we do something called prepaid insurance schedules. You should be keeping them. As a board of directors, you should be having a prepaid insurance schedule. We receive that and we audit that. You'd be very surprised on how many communities do not have that. And you need to have that so we can audit that and adjust it if it's incorrect. And then also deposits. Do you have any deposits down, like FP&L? Many associations have deposits with FP&L over years, and we audit those. But the problem is a lot of times FP&L will not give us that information. So what we have to do is go back to the board of directors or management, ask them to reach out to FP&L to get clarification on that. Because sometimes those deposits actually go through the bill. So they lower your bill instead of sending you a deposit back. And you don't even realize that you don't even have a deposit anymore with FP&L or any of the utility companies. Liabilities, accounts payables, we discussed. Prepaid maintenance fees, another area that we audit to make sure it's accurately stated. Refundable deposits. This is my favorite. So many associations don't have a schedule that ties out to the refundable deposits. It's a problem. It will actually cause a modified or disclaimer of opinion if it's material to your financials. What I mean, we had an association that had $250,000 worth of refundable deposits with no schedule. That's a problem. Who is this owed back to? Have you refunded any of it? It was a major issue. So refundable deposits, first, you should have a policy in place set up by the attorneys of refundable deposits, of keeping a schedule. When do you refund them? If you can't reach somebody or get it back, what do you do with that money? That's who you talk to the attorneys for or your management company on how to handle that. But you need a schedule. Deferred revenue. Did you pass a special assessment and not spend all the money? And it's sitting on the balance sheet as deferred revenue. A lot of times we'll see this, we'll take on a new community and they had deferred revenue from 10 years ago. And they say, no, we haven't done it yet. We know the cash is gone. We know that the cash is still not there. You've spent it. You should recognize the revenue. If you really know in the next 2 or 3 years it's left over and you haven't spent it, that's different. But if you have deferred revenue from a special assessment 10 years ago, most likely that cash has been spent and you really don't have it left over. So we talk to our boards and say, do you want to recognize this as revenue so we can take it off your balance sheet? And then your note payable, as we discussed, how we audit that area and make sure it's correct. We also do comparables too, to make sure what you're paying in your interest is comparable to what other associations are paying. We all know that's changing in the next couple of months where those interest rates will be, but we look at that and we look at, are you overpaying? Are you comparable? So part of an audit process is to do analyticals also compared to other associations that we do. Fund balance and equity. So we make sure that where are you equity-wise? Do you have enough if you needed to pay all your liabilities? Are you financially solvent? Are you a community that's doing everything you should be to be financially solvent? If you're not, there will be comments either in the footnotes or in the internal controls saying to you of recommendations we believe you should be doing as a board of directors. What is an income statement? So as I said earlier in the presentation, everybody loves the income statement. Everybody goes there first. They want to know, where do we end the year? How did we do? What is the purpose? The purpose of the income statement is to show management, board of directors, did we make money? Did we have a loss? Where were we? As the auditors, we're looking at that. That's an area of a lot of testing, of a lot of looking at, are these financial statements correct? Are they spending in the right areas? Are they classified correctly? Are they putting things in the right areas? A lot of auditors don't do reclassifications. Our job is to not do bookkeeping, but we make sure if something doesn't look correct in another area, we do suggest adjusting entries. Remember, the auditors are recommending adjusting entries. The board has to accept them at the end of the audit. We do not force you to accept them. You must look at them and say, do these make sense? And we have many come back to us and say, this is not correct, or this shouldn't be in this area, and we can make changes to those. You always must remember, these are your financial statements. We're auditing them and making recommendations, but the bottom line is you own those financial statements. So on the income statement, we look at that and we make sure, where's the bottom line? Have you guys assessed enough? Where's other revenue coming from? Are you collecting cash? Do we see that, for example, we had an association that a lot of the application fees were coming in and being paid in cash. So we looked at the amount of sales were in that building for that year and how much they collected in that other revenue. Was it realistic? Do we believe they collected the amount of money? Was it recorded properly? The auditor's job is to do that, to make sure revenue is stated correctly, that it is not understated or overstated. It's very important. And then the expense area, making sure that it is correct, that you guys are, the expenses are recorded in the proper period and that they are legitimate association expenses. That is a job of the auditor, and making sure they report it to you that if it is done correctly. What is a cash flow statement? So a cash flow statement is basically, I always try to explain this because a lot of people don't understand the cash flow statement. It can be very confusing on the financial statement, but it's basically looking at last year, the end of last year, what cash came in and out of that account. So let's talk about receivables. Cash in and out of the receivables versus the ending balance. That's cash flow. It's actually a cash flow statement. It's truly cash in and out, and then giving you an ending balance. The cash flow statement on the financial report is the net change of the cash. So what I mean by that is from the beginning balance to the ending balance, what is the net change in that cash flow? And a lot of times people don't have enough questions on the cash flow statement. It is very important. A lot of your lenders, a lot of your people that are buying in these communities do have a lot of questions on that, because some of them do understand that and make sure that they review that. What are footnote disclosures? So footnote disclosures, I have many boards that don't even want to go through the footnote disclosures. And I say, that's actually the most important part. I want you to read those footnotes. As an auditor, I encourage you to read them. Why I say that? We technically in an audit, if you go to the big firms, like if you go to a Deloitte and they're auditing Ford Motor Company or they're auditing these big companies, they don't write the footnotes. The Ford Motor Company writes their own footnotes. The auditor audits those footnotes. In this industry, that's not what happens. We could never expect the board of directors that are volunteer, they have enough to do with just their own lives and running an association to write those footnotes. So the auditors in this industry write the footnotes. And then what happens is the board of directors signs off on those footnotes and accepts them as their own. So the auditors are writing them. And what they're doing is they're disclosing everything that is material and important to be transparent to the end user. So they're disclosing what is the association, the organization, what is the FDIC, what is the reserves, what is the note payable, and fully explaining in detail everything that ties back to that financial statement. Very important. The footnotes are a description of everything that's happening to understand that. Examples of footnotes. So the financial statements, your balance sheet, going through specific areas in the balance sheet, the statement of revenues and expenses, the statement of cash flows, notes the financials. The supplemental information is the most important footnote disclosure because it is required under 718, 719, and 720, a lot of footnote disclosures on the reserves. The state has been adamant about that, what has to be disclosed. For example, under 720, if you are voluntary reserves, it must be in capital and bold on the audit report. A lot of times I'll do HOA audits and they say, why is that in bold and capital? It's required by the state. We must put that in there. And the reason is we want people to see that. that these are voluntary reserves and there's always a potential for a special assessment. So there are reasonings for those footnote disclosures to be the way they are. We don't just say, oh, we want them capital and bold. There is a reason behind it. So it is good to ask your auditors that. Concentration of credit risk. That I'm going to give you some examples of important footnotes. Concentration of credit risk, very important. Is your balance exceeding the 250,000? We must disclose that. If you have different vehicles like the sweep or the Cedars program, then it would say the balances may exceed at times, but it's not going to say you're over. If you don't have those vehicles, it will say the actual dollar amount and the exposure that the association has under the FDIC. Income taxes must be disclosed. So I included the formerly FIN, all of that in there because it's not in the audit reports anymore, but I wanted to give some people some background on some disclosures. But we do disclose, are you filing an 1120H under the section 528? Are you filing an 1120 with a Florida return? If you're filing the 1120, do you have any net operating losses carry forwards? We disclose all of this. So anybody that's reading this can understand what tax return you're filing and if there's any income taxes that are due. We also, as the audit process, most of you have your taxes performed by your auditor, and they look at that and say, what form should we be filing? What is more beneficial to the community to file? Litigation. Litigation is a very important part of your financial statements. It must be disclosed. So our firm, and every firm is different, we actually have our board of directors fill out a form called a legal confirmation, and they disclose to us if they have litigation or they don't. If they disclose they have litigation, then the auditor sends a letter to the attorney and gets a confirmation back. So we know if we have to disclose something in the audit. If the board fills out there is no litigation, we still go through those bills and make sure we don't see anything outstanding, or maybe they didn't disclose to us. So we still look through those bills to make sure if there's anything outstanding. Special assessments. You must disclose about special assessments. You must disclose the amount, what it's used for, and the expenses that are associated with, and if there is leftover money. It must be fully disclosed to the end user. So that is a full part of your footnotes. Always make sure you read those footnotes. Make sure you understand that, because sometimes in the minutes or the communication isn't as accurate as you telling us, and maybe there's something that's misstated. Maybe in the minutes it stated it was used for this, but you want to add a little more verbiage to it. Always be as more transparent as possible. Future major repairs and replacements, the association must disclose that. You must disclose, are you fully funding? It must disclose the amount, and it must disclose the next year. So I have a lot of people ask me, why are we putting in 2022's funding amount? It's required by the state. It's also required by the state a certain paragraph, and it's right here. Actual expenditures may vary from estimated amounts. It talks about you may not be adequate to meet all future needs. I've had boards ask me why the auditor hasn't this. We want this out. You don't want this out as a board of directors. I'll tell you why. Those reserves and reserve studies are estimates. You may not have enough for future needs. You want to protect yourself as a board that everybody knows they're estimates. And it doesn't mean that you won't have a special assessment. There's always a potential. Just like when people had reserve studies done in 2019, and then 2020 came, the pandemic, the inflation, and now they're looking at their roof and it's twice the amount of what the estimate was. Thank God that disclosure was in there, because now they can't come back to you and say, well, you told us it was 3 million, but the roof's 6 million now. You've had it in there that it's an estimate. It's very important. We're coming up to our last, I know we're coming up to the end, so I'm just going to quickly go through this. The AU 260 is just communication with you. If there's any issues during the whole audit, it'll state it in this letter. Most likely you wouldn't have anything in this letter, but it does report if we had complications or issues with management. And then I have any questions. This is my email, all my information. I can provide the presentation, and I'd love to answer any questions. I really appreciate everybody's time today. I hope I was informative of how the audit process works. I know it's a lot of fun, but to everybody else, it might not be as exciting.
Thank you, Nicole. That was really great. A lot of people asked, are they going to get the slides? Yes, they will be emailed to you. not by Nicole, but by Ashley. Everyone in attendance will get a copy of the slides.
Perfect.
If you do want to view the presentation again, it has been recorded and you can go on campbellevents.org. That's campbellevents.org. And you can rewatch the presentation. We do have a couple minutes here. Let me just look through the questions.
Yep.
See if there's anything we can do to close out. Someone asked about not having had an audit for 8 years because the management team has taken a vote of the residents and it has been, the audit has been voted down. Is that legal? I think you did address that. Yes, statute does allow associations to waive the reserve requirement, correct?
Correct.
Okay. Someone asked how far back should an audit go? And if you wanted to go back further, is that possible or recommended?
So, I mean, that's a great question. What I always say is, if you think something's going on and you think it's been going on a long time, do the current year. Because fraud, if you think there's fraud or errors, it always escalates bigger at the end. So if you find it in that year, if you find nothing, there's no reason probably to go back because most likely nothing's going on.
Someone says we are an association required to have an audit. What is the deadline? I think you addressed that, but one more time for everybody. What is the deadline?
April 30th to all unit owners.
Thanks. Someone said there's new requirements for reserves, FASB, ASC 606, which I heard you mention, I think. Someone's saying, where should we look to truly understand where our reserve accounts stand?
Great question. So what I would just recommend is your equity, your fund balance in reserves on your income statement, plus your contract liability on the balance sheet is all your reserves.
Okay. During a third-party audit, will the previous year's audit by a different firm be reviewed and or taken into account?
Yes. So what the new auditor does is reach out to the prior auditor. They're required, send a letter, a questionnaire, and ask if they need to see their work papers because they have to make sure those balance sheet beginning balances they're comfortable with.
Okay. A couple of these I'm not quite sure. I'm not going to get into those. I think we pretty well addressed everything. So again, Nicole, thank you very much. Really appreciate your time. Incredibly informative. Again, Nicole's information is here. If you are looking for an association auditor, Nicole again has a great reputation along with Hafer and Company. So please do reach out to them if you're not comfortable with your current auditor. And if you need property management services, please don't hesitate to reach out to us at Campbell Property Management. My email address is ebradley, that's EBRADLEY at campbellproperty.com. So hope everybody has a wonderful rest of their afternoon, and we'll see you all on another webinar again soon. Thanks, Nicole.
Thanks, everything. Thanks, Evan. Great job. Thanks, Ashley. Have a great day.
Bye.
Thank you.